Let's see what are the topic which we are going to study here. First of all, we will see the objective, then introduction. What is the role of financial sector regulator in the economy? Third topic, Reserve Bank of India, Security and Exchange Board of India, that is SEBI, IRDAI, that is Insurance Regulatory and Development Authority of India, and finally PFRDA. So this particular chapter is going to be long, so we will bifurcate this entire syllabus, entire topic in 3 parts or 4 parts. So basically you will get 3 videos or 4 videos part wise. So let's get started with our first topic, that is the introduction. So have you ever wondered who keep India's money system safe and fair? So first of all comes RBI, Reserve Bank of India. You know it. They control money supply, they control loan, they keep inflation in check. Then we have SEBI. SEBI, Security and Exchange Board of India. These are regulators. So basically there are 4 main authorities. SEBI, Security and Exchange Board of India. So this is basically a stock market watchdog. They ensure that no insider trading happen or no fraud happen. For example, suppose a company lie about profit. So SEBI fine it to protect investor. So third regulator is the IRDA. So IRDA, stands for Insurance Regulatory and Development Authority of India, right? So basically they are the insurance guardian. They make sure that policies are not a scam. And finally we have PFRDA, that is Pension Fund Regulatory and Development Authority. So they are retirement protector. We can call them, retirement protector. Okay, so they oversees pension fund like NPS. Now the question is, why do we need them? Yes, we are talking about their role. So why do we need all these entities? Why do we need them? Because financial system is just like economy's backbone. The financial system acts like a backbone of Indian economy, like blood vessel in a body, right? Similarly, financial system to the context of Indian economy, right? So like blood vessel in the body, bank and market keep the money flowing. Just like blood vessel keep the blood flowing, similarly bank and market keep the money flowing. That is why it is called the backbone of Indian economy. It prevents the chaos. Yes, it prevents the chaos. That without regulator, imagine a stock market where company hide losses, inventor would lose trust. Yes, and then for fair play, yes, this is also very important, right? Just like referee enforce rules in cricket. Referee, they enforce rules in cricket. Similarly, SEBI ensure that no player cheats. So if we talk about the key goals of regulators, so what are the key objectives of regulators? The first one is the public confidence, which means like a doctor degree assure patient. Similarly, regulator make you trust bank and insurer. That is called public confidence. Second is the investor protection, or protecting the investor. So SEBI mandate company to share true financial report, no fake profit chain, no fake profit, right? True financial report, it help you to it mandate company to share true financial report. That is how it protect the investor. Then we have the fair market, right? Fair and efficient financial market. So RBI ensure that bank don't charge crazy interest rate. So this IRDA, it cap insurance premium, right? IRDA cap the insurance premium. So these are the key objectives: maintaining public confidence, protecting investor, and promoting fair and efficient financial market. Okay, so these are the example. Let me give you real life example. Suppose you invest in companies X share. Why you invest in company X share? Because they report huge profit. Later you discover that they lied. So as SEBI will step in such case. SEBI will step in. They will find the company, they will ban its director, and they will refund the investor. So this is regulation in action. So let's recap what we have discussed just now in this particular slide. I have told you there are 4 regulators, right? I have told you the name of those 4 regulators. The first one is the RBI, second is SEBI. RBI is for RBI is for bank, okay? And I told you this SEBI is for SEBI is for stock, okay? Then IRDA, I told you IRDA is for insurance. And finally I told you PFRDA. So this PFRDA is for pension. So these are the 4 regulators. What are their role? Their role is to maintain trust. Their role is to prevent fraud. Okay, and their role is to ensure fairness. Trust, fraud, and fairness, like referee in a game. Now the question is, why does it matter? Because if there is no regulation, suppose there is no regulation, it will be chaotic. It will be more chaos, right? A scam will be there, and market will get crash. So I hope that makes sense to you. Now friends, have a look at RBI, the role of RBI, that is the Reserve Bank of India. Very important aspect which are going to discuss. So did you know that India's central bank, the RBI, was not always the powerhouse as it is today? Let's time travel to uncover its fascinating journey. First of all, it was proposed in 1927. As you can see, it was first proposed in 1927 and it was born in 1935. Right? So like a delayed train, the RBI idea came in 1927 but started only on 1st April 1935. Right? It was not an April Fool joke, right? Why? Because earlier, Imperial Bank of India. Earlier, what used to happen? There was a bank called Imperial Bank of India. Okay, so earlier Imperial Bank of India. Now this is called SBI. So Imperial Bank of India and the British government handle banking. So Imperial Bank of India combined with the British government, both of them handle banking, but very poorly. Yes, they handle banking, but very poorly, right? Imagine your local grocer also managing the town's electricity. It will be chaos, right? So the brain behind RBI, who are the brain behind RBI? Dr. Ambedkar book. Here you can see, right? The RBI conceptual framework was influenced by the Dr. B.R. Ambedkar book. What was the name of the book? The Problem of the Rupee, its origin and its solution, right? It saved the RBI. Now then comes, Hilton Young Commission. Remember the commission name? Hilton Young Commission. So a British committee, it suggested that India needed a dedicated central bank. Like how a school need a principal. Similarly, India needed a dedicated central bank. This was suggested by a British committee. And the name was Hilton Young Commission. Now, if you look at the RBI earlier day, so it served two countries. Earlier, RBI served two countries, India and Burma. Burma is also called Myanmar, right? So it was central bank of both the country till April 1947. Like one teacher managing two classroom. And headquarter, it headquarter was earlier in Kolkata, right? But it moved to Mumbai in 1937, just like shifting home for a better job location. Then comes, from private to government, that is called nationalization. You know it very well. Initially, it was a private bank owned by shareholder, but boss. So the RBI governor is the boss, right? Like a CEO. So the RBI governor is there, and plus, beside RBI governor, there are 4 deputy governor. So governor plus 4 deputy governor, right? All appointed by the Indian government. So all this governor and the 4 deputy governor, they are appointed by the Indian government. So that is the governance structure. Okay, so the boss is, the governor is the boss plus 4 deputy governor. And if you look at the board, yes, have a look at the board. So if you look at the board, so it includes expert from farming, industry, and even government official. So there are expert from farming. Okay, they are expert from, industry experts are there, and they are experts from government official. Okay, so they include board, as you can see, nominated from various field to government official, 4 other representing local board, etc, etc. Now if you look at the government role, what is the role of government? The RBI is not fully independent. The government can give direction for public interest. Already I told you that RBI is not fully independent. Government give direction, right? Government give direction, right? So for public interest, government can give direction. For example, during COVID, RBI slashed interest rate. Why it slashed interest rate? Because the government want to boost the economy. Okay, so government time to time give direction to the RBI. Because RBI is not fully independent, right? That is the point. So imagine your colony RWA, that is a Resident Welfare Association, is elected to manage the fund, but the municipal corporation can overrule them for bigger issues. That is how RBI and the government work together. So just now what we have covered, let me summarize. I talked you about establishment of RBI. Let's summarize here. Yes. So I talked you about RBI establishment. So when it was established, it was on 1st April 1935. RBI was established, right? After years of planning. From where it draw inspiration, right? I told you it draw inspiration from Ambedkar, right? It draw inspiration from Ambedkar ideas plus British Commission. Then I talked you about earlier role, right? I told you about early role of RBI. So early role of RBI, it served India and Burma. I told you it served both the country, India plus Burma. Now HQ, headquarters shifted to Mumbai. Then we talked about the nationalization of RBI. What we come to know that yes, it became government owned in the year 1949. In the year 1949, it was nationalized. Earlier, Imperial Bank of India. Then leadership, yes. If we talk about the leadership of RBI, we come to know that there are governor, there are deputy governor, 4 deputy governor are there, and plus there are diverse board members. Okay, I hope that makes sense. Now, if you talk about the objective of RBI in detail, yes, have a look. So basically, RBI, you can think of RBI as the India's money doctor, right? India's money doctor, because it keeps our economy healthy, it control cash flow, it protect our saving. Let's understand how. First of all, what is the big goal of RBI? The big goal of RBI is to achieve the monetary stability, that is called money stability. So what is money stability? Basically to control how much money prints, right? To regulate the issuance of banknotes. So basically to control how much money print, like a printer with a stop button. Suppose there is a printer, okay, and this printer come with a stop button. Fine. So why money stability? Because it prevent price from skyrocketing, right? So monetary stability prevent price from skyrocketing. That is the main motive of this monetary stability. For example, if RBI print extra note, right? Suppose RBI will print extra note, you will get 100 rupees burger might cost rupees 150. That is called inflation. Okay. So it prevent price from skyrocketing. Then next point is bank safety net. First one I told you is the monetary stability to regulate the issuance of banknote, and the second is the financial stability. So what is the financial stability? So I told you it ensures that bank don't gamble with your deposit. Okay, it ensures that bank don't gamble with your deposit. Why? So you never hear sorry your bank vanished overnight. That is called financial stability, or we call it bank safety net. This is called bank safety net. Fine. So that you never hear sorry your bank vanished overnight. Such thing you will never hear. Third point is smooth payment system. RBI makes sure that UPI net banking never crash. That is the point. So this kind of payment system like UPI, this net banking, so this thing never crash. This is ensured by RBI. So imagine playing at a store and the app fail. So RBI prevent this chaos. That is called a stable payment system. Then comes nation first banking. That is called alignment with the national priority. So it guide bank to lend to farmer or MSME, not just luxury mall. Yes, that is national priority or what? Like farmer. Yes, farmer is national priority. Like MSME, this is a national priority. So it guide bank to lend to farmer and MSME. RBI may say give 40% loan to rural area to boost village. Then comes RBI superpower. How it works? Have a look. RBI superpower. First one is the money controller. What is meaning of money controller? You can change interest rate to control spending. You can see to control the overall volume of money, you can change interest rate. For example, suppose rate increase. What will happen? Loan will become costlier. Right? Loan will become costlier. And what will happen ultimately? You will buy less. Since loan become costlier, you will buy less, and ultimately price will drop. So you can see interest rate increase can have domino effect on the price, as you can see it here. Then it is only legal money printer. It designs secure note and replace the torn one. Okay, so that is called legal money printer. It is a government bank. Yes, right. It manages Modi ji's salary account. Just kidding, but kinda true. Also handle India's debt. Okay. So these are important part of the, yes, here you can see bankers to bank, that is banks bank. It save collapsing bank. You might have heard about yes bank crisis. Have you heard of this yes bank crisis? It happened in 2020. So RBI stepped in like a superhero. So that's why it is called banks bank. Then it also manages the dollar. That is called manager of foreign exchange. So suppose you buy or sell dollar. Basically what it does, you buy dollar or you sell dollar, okay, to keep rupee stable. You have to keep the rupee stable, and for that you are either buying dollar or you are selling dollar. For example, let's suppose if rupees fall to $1 is equal to rupees 90. Suppose this is obviously falling of rupees, right? So RBI sell dollar. What RBI does? RBI sell dollar in such case to save it. Fine. So that is called manager of foreign exchange. Then comes UPI bodyguard. So it ensures that Paytm, Google Pay transaction are fraud proof. And then there is something called financial gardener. So it plant banking in rural area and grow digital payment. It plant banking in rural area and it grow digital payment like Vim UPI. So let me give you some real life example to make this thing more clear. So COVID, if we talk about 2020, what happened? COVID hit, right? COVID hit. What happened? Business starved for cash. Then what RBI does? RBI decrease the interest rate. What happened next? Loan get cheap, loan get cheaper, and what happened then? Economy revive, economy recover. So basically, as you can see here, RBI come to the rescue because it decreased the interest rate, loan get cheaper, economic recovery happen. So let's recapitulate the role of RBI in just 3 points. So basically, we have covered so many points. I am just recapitulating in just 3 points. You can remember. First one is the goal. I told you the goal is to maintain the price stable. The goal is to have safe banking. Okay. The goal is to have a smooth payment. And the goal is to have inclusive growth. These are the goal. Then we have the power. Okay, what is the power of RBI? I told you it control money. To control money, it save bank. This is the power. It guard your rupee, and it backs government. So these are the power. And I told you about the motto of RBI. The motto of RBI is that your money safety and India's prosperity. That is the motive. Now friends, have a look at the monetary policy objective. So what is the meaning of monetary policy objective? So the question is, suppose you are holding a 200 rupees, 2000 rupees note and a vegetable basket. Suppose you have two things. On one hand you have 2000 rupees note, and on the other hand you have a vegetable basket. Now the question is, why do onion make us cry twice? First, when we chop them, and then when their price also increase, right? Two times onion make us make us cry. Why? First of all, when we chop them, and second, when their price rise. So meet RBI monetary policy team. They are India's inflation firefighter. First of all, RBI three major money goal. What are the three major money goal? To maintain the price stability. So basically that means keeping the inflation in check, like an AC thermostat. Suppose tomato price, take the example, suppose tomato price hit 200 rupees per kg. So what RBI will do? RBI will increase the rate. What will happen? Loan get costly. As RBI increase the rate, loan get costly. So people buy less. People will buy less. As loan get costly, people will buy less. And people will buy less and price will cool down. So this is how price stability is maintained. Second, I told you about three goals. The first is the price stability. Second is the growth fuel. Yes, this is the key point. This is called growth fuel. What is the meaning of this? So it ensures that loan reaches the business. Yes, it ensures that loan reaches the business. This is what is ensured. Fine. For example, MSME get cheaper loan to make in India product. Right. So this is one example which I am giving you. Take the case of MSME. So what MSME is doing? They get cheaper loan. Why they get cheaper loan? To make in India product. You might have heard about make in India. To make in India product, MSME get cheaper loan. And then finally, the third important goal of RBI is to maintain the financial safety net, which means to prevent bank collapse, to prevent bank from collapsing. Right? This is the third important thing. Like a lifeguard at the economy pool. So remember, so far as monetary policy objective are concerned, RBI has three major goals. First, the price stability. Second is the growth fuel, and the third is to prevent from bank from collapsing. Now the question is, how RBI achieve this? So goal is clear, three goals are there. Now how RBI achieve this? So there are some tools which RBI use. The first tool is called CRR. Yes. So the first tool that RBI use is called CRR, SLR, right? And besides that, there is a monetary policy committee that is called MPC. So there are some instruments which we are talking about. Yes, we are talking about a monetary policy committee. So what is this monetary policy committee? Have a look. So this is a 6-member committee, as you can see. It was established in 2016 under the section 45 JAIIB of the RBI Act, and there are 6 members, 3 members from RBI and 3 members from government. Okay, and those 3 members who are from RBI are the governor of RBI, deputy governor in charge of monetary policy, and 1 RBI nominated officer. So these are the 3 RBI officer, and then 3 members appointed by the central government. So total 6 members are there, right? So suppose inflation cross 6%. So they must explain to government, right? That why inflation cross 6%. That is the point. So let me give you one example of COVID-19 rescue to make it more clear. So what happened? Economic crash. When economic crash in March 2020. Okay, what happened? RBI cut rate. RBI decreased the rate. I am talking about the COVID scenario. Economic crash. RBI cut the rate. Since RBI cut the rate, So EMI drop, EMI decreases, people and business borrow and recovery begin. So in that case, RBI decreased the rate. So just now what we have discussed, let us summarize. I'm just summarizing here. So first of all, we talked about RBI Trinity. What's the meaning of Trinity? So I told you it control inflation. So it keep inflation in check, almost 4% target. It boosts growth. And the third one is save bank. So this is called RBI Trinity. And we talk about the power tool that RBI have. In order to achieve this Trinity, there is a power tool that RBI have. First one is the CRR, second is the SLR, and third is the repo rate. So this is called power tool. And then we talk about MPC, that is a Monetary Policy Committee. This is a 6-member committee, right? And they meet bi-monthly. Remember, they meet bi-monthly. Okay, so that's how this thing is all about. Now if we talk about the instrument, yes, I told you now there are two kinds of instrument that RBI have. The first one is called the cash reserve direct instrument. Second one is called indirect instrument. So if we talk about the CRR, what is CRR? CRR is called cash reserve ratio. Okay, so bank must keep, actually it varies. So they are required to maintain a certain percentage of their NDTL, that is called net demand and time liability, as cash with the RBI, because the name itself say cash reserve ratio, right? So what is the effect of it? See, the effect is quite clear. So less cash will be with bank, since they have to deposit cash with RBI. So bank will have less cash. Ultimately, what it will do? There will be fewer loan. So since bank have less cash, so loan will be fewer. And since loan will be fewer, so spending will be less. So less spending. And since the spending is less, so what will happen? Inflation will decrease, right? So that is the role of CRR. Now if we talk about the SLR, so I hope it is clear regarding CRR. Now SLR is called a statutory liquidity ratio. What is this SLR? See, so in that case that bank must invest 18% in government security and government bond. So basically high quality liquid asset, that is called HQLA. And what are the eligible asset? It include cash, government security, gold, right, and other RBI specified security. So these are the asset in where amount of SLR are invested by the bank, right? So they must invest. Why so? Because the bank don't gamble with your money. That is the reason. So just now we talked about CRR, we talked about SLR, right? So SLR, if the bank have CRR, so bank less cash with bank, fewer loan, less spending, inflation will decrease. And we must know that on CRR balance no interest is paid, right? And this is most important fact, that CRR has to be prescribed under the section 42 subsection 1 of the RBI Act. Okay, and there is no floor, no ceiling. RBI may set the CRR without a floor and ceiling according to the monetary stability need. And you must remember what are the assets which are included under SLR. This is very, very important. Okay, now have a look at the indirect instrument. So what are the indirect instrument? Suppose you are holding a water tap and a bucket. Ever seen a plumber control water flow without touching pipe? That's RBI. It is just like RBI daily money valve. Okay, you can think of RBI daily money valve. So it pump cash in, that is repo, or it suck it out, that is reverse repo. See, very simple. You can think of them like money valve. Okay, so cash is pumping in, cash is being pumped in the case of repo, and cash is being pumped out, right? That is the case of reverse repo. Okay, so let me give you one example. For example, like a bank manager who lend 100 rupees today but take back 102 tomorrow. So that is the point. So basically daily injection or absorption of liquidity through repurchase and reverse repurchase. Okay, this is the first point. Second is the collateral. Yes, collateral. So bank plays government bond as security deposit. That is the point. So what bank do? Bank plays government bond as security deposit. So government bond is placed like security deposit, right? So that is a kind of collateral in the case of liquidity adjustment facility. So what a scheduled commercial bank do? They borrow from RBI at the repo rate by pledging eligible security above their SLR requirement. So this is how LAF work, that is liquidity adjustment facility work. Second thing we have is repo rate. What is repo rate? So repo rate is like master switch, and the current repo rate is 6 point, actually it varies, we can't say current repo. Okay, so basically when RBI changes the repo rate, what happened? Your EMI, your FD rate dance to its tune. Okay, so it represents the policy rate for LAF transaction and it determines the short-term money market interest rate. Then the third indirect tool that RBI use is OMO. What is OMO? Open market operation. What it is all about? So open market operation means what? RBI either buy or RBI either sell. What it buy sell? It buy sell government bond. RBI will either buy the government bond or RBI will either sell the government bond. Why? Why it will buy and sell the government bond? To add or remove the cash from the system. Either to add the cash or to remove the cash from the system. Right. So this is why OMO comes into picture, to either add the cash into the system or to remove the cash from the system. Right. RBI buy or sell the government bond. So what is the real impact of it? The real impact, suppose RBI is buying 10,000 crore bond. Suppose RBI is buying 10,000 crore bond. So what will happen? Since RBI is buying bond, so bank will get cash. Okay, so bank will get cash, so bank will give more loan, and since bank will give more loan, economy will revive. Economy will revive. So this is how it is happening. OMO, open market operation. Then there are some emergency button like MSF. These are emergency button. Okay, MSF and SDF. So MSF, it bank nighttime ATM. Yes, nighttime ATM. You can call MSF as night time ATM. Okay, so what happened here, that you borrow at 7.5%. Suppose repo rate plus 1. So this 7.5, suppose repo rate is 6.5. Repo rate is suppose 6.5. So you borrow at repo rate plus 1%. Okay, even using SLR bond. So using SLR bond, bank can borrow at repo rate plus 1%. And what is the SDF? What is the standing deposit facility? The standing deposit facility is the RBI vacuum cleaner. We can call them RBI vacuum cleaner. Why? Because it absorbs the extra cash. RBI use it to absorb the extra cash at repo minus 0.25. Okay, so one thing you can see that MSF is repo plus 1% and SDF is repo minus 0.25%. Okay, so these are upper limit and lower limit. These are also called limits or buffer, upper buffer, lower buffer, just like that, MSF and SDF. Okay, so MSF acts like a bank nighttime ATM and SDF acts like RBI vacuum cleaner. Okay, so RBI use SDF rate to absorb the extra cash. That is the point. Now why this matter to you? So we'll have a look. So if we talk about all this point regarding MSF, SDF, so suppose you take home loan. Okay, take the case of home loan. Suppose repo rate increase, so your EMI will increase. Suppose repo rate decrease, or suppose that is the case of home loan. Take the case of saving. In the case of saving, suppose reverse repo rate increase, so your FD rate will increase. Right. Take the case of business. So suppose OMO cash injection, OMO open market operation, I told you here RBI buy and sell the government bond, and that's why it add and remove the security. I give you one example like 10,000 crore bond, right? So RBI buy, so ultimately bank get cash, more loan and more economy revive. So this is how open market operation help in, this is the indirect tool which RBI use, OMO. So in the case of business, OMO cash injection is happening. So obviously business loan is become easier. So let me give you one example. What happened in 2013, in 2013 when rupee crash. In 2013 what happened, rupee crash. Okay, rupee crash. So what RBI did? RBI used MSF to stop bank collapse. To stop bank from collapsing, RBI used MSF as a tool. Okay, so let's just summarize the indirect facility which we have just talked now. What are the indirect tool available to RBI? Let's summarize. The first one I told you is the LAF. So what is LAF? LAF is just like daily money valve. LAF is like daily money valve, and it includes repo and reverse repo. Repo and reverse repo. Then we talked about the repo rate. What is the repo rate? This is master. This is master interest rate. Master interest rate. Okay, then we talked about OMO. These are indirect tool, remember, OMO. OMO, basically what is OMO? OMO is open market operation. So this is bond trading for liquidity. You are trading bond for liquidity. This is called bond trading for liquidity. And then we talk about MSF and SDF. Okay, so these are two limits. They are emergency cash button. They are emergency cash button. I told you na, SDF is like RBI vacuum cleaner. MSF is like, you know, night time ATM. So that's why they are called emergency cash button. The dealing happen in the cash. One is the repo rate plus 1%. MSF rate is repo rate plus 1%. SDF rate is repo rate minus 0.5%. So the next time your bank changes loan rate, remember RBI press some button in Mumbai for more finance decoded. I hope that makes sense to you. Now friends, so we have discussed all kinds of indirect instrument that we have. Okay, so then one more topic is MSS. Have a look. So friends, when cash flood the market or state run broke, RBI has some special rescue. So let's talk MSF. I already told you about MSF and SDF. MSF are like, you know, bank panic button to get overnight cash at repo rate plus 1%. And SDF is like RBI cash vacuum, right? Sucking extra money at repo rate minus 0.25%. Fun fact is that together they create interest rate sandwich. Right, so together this MSF and they are called policy corridor, right? So they are two bonds, upper bound and lower bound. MSF is the upper bound because the rate is repo rate plus 1%, and SDF is the lower bound. Rate is repo rate minus 0.25%. So it forms, you know, a kind of interest rate sandwich. Right, so that is the point. So repo rate is cheese in the middle. So what is the repo rate? It's kind of cheese in the middle. You can think of them like that. Now let's talk about the MSS, that is market stabilization scheme. What it is all about. So we can call it excess cash sponge. Excess cash sponge, or we call it, you know, excess liquidity absorbing. Means excess cash sponge you can call it. So MSS is the excess cash sponge since 2004. Okay. Now, so this is what it's all about. Now question is how it works. See, it sell a special bond to soak up extra money. So what happened here? Here we sell some bond. Why we sell some bond? To soak extra money. To soak extra money, we sell the bond. Like, you know, selling concert ticket to control the crowd size. Let me give you some example of this MSS. Like, you know, when foreign investor flood India with dollar, RBI use MSS to prevent inflation. Okay, so RBI maintain a dedicated MSS cash balance from the government. So MSS we have talked about it, just like, you know, excess cash sponge. What you do, you sell bond to soak up extra money. Okay, now the next point, we have banker to the state government. So RBI act like a state banker. So every state must keep minimum balance with RBI, like your bank minimum balance rule. The trouble is that state get WMA. What is WMA? Wage and mean advance. The state get this wage and mean advance. So what are these wage and mean advance? Have a look. These wage and mean advance, you know, they are short term loan. They are like, you know, short term loan. Okay, like, you know, salary day overdraft. Salary day overdraft. So this is the kind of short term loan. Okay, so this wage and mean advance is a short term loan. And if we talk about the overdraft facility, what is this overdraft? So these are like, you know, emergency cash, but with a strict time limit. So this is the trouble. So what I'm talking about, that a state government banking rule is that every state must keep minimum balance with RBI. First point, they must maintain a minimum balance with the RBI. This is the first thing. Second thing is that trouble is that state get WMA. WMA stand for wage and mean advance, which means short term loan. It is a kind of short term loan like salary day overdraft. And overdraft also they get, first of all they get, state get WMA, which is a kind of short term loan, and also they get overdraft, which is emergency cash. You know, real crisis when happen? Real crisis happened during COVID-19. During COVID, a state like Maharashtra took WMA. They took WMA to pay healthcare worker when tax dried up. You know, in the state like Maharashtra, tax completely dried up. Okay, so they took help of WMA to pay healthcare worker. So let's summarize the point which we have just covered in this particular slide. So what I told you, that MSF, you know, is like bank emergency window. MSF is like, you know, bank emergency window. We talk about SDF. SDF is the RBI cash vacuum, right, in the economy. What RBI launched? RBI launched financial vaccine to save the economy. Let's decode RBI crisis toolkit and money magic. The first one is the RBI pandemic lifeline 2020 special. The first is called LTRO and TLTRO. So what this LTRO and TLTRO is all about, have a look. These are, these are economic ventilator. They act like, economic ventilator. Why we call it so? See, these are 1 to 3 year cheap loan for bank, right? So these are 1 to 3 year cheap loan which is given to bank at the rate repo rate. So you can see 1 year to 3 year tenor policy repo rate. So this is about what is the mission of it. So what we answer that yes, it is 1 to what we have just answer what. Now the question next is mission. What, why? So basically the mission is to push bank to lend to business, not hoard cash. That is the main mission. That to supporting medium to long-term credit flow to productive sector, means to push bank to lend to the business. Then comes TLTRO twist. TLTRO twist. What happened that bank must invest in the corporate bond. You can see written here clearly that they must bank to invest the proceed in the corporate bond. So it direct help to the company. Either they have to invest in the corporate bond, commercial paper, non-convertible debenture, any of these, right? So it direct help to the company. So real impact you can see like giving 1,000 rupees to a friend to keep their shop open during lockdown, right? Just I'm giving you one example. So this was the real impact. I hope that makes sense. Why it is called economic ventilator, I hope it is clear. So it is given for 1 year to 3 year tenor, and they support, it act like a supporting medium to long-term credit. The mission is quite simple: to push bank to lend to business, not to hoard the cash. And I told you that bank must invest in corporate bond, so it provide direct help to the company. Okay, now if we talk about the WMA rule for the state, yes, have a look at the WMA rule for the state here. So there is something called 36-day rule. What is this 36-day rule? Have a look. It says that state can take short-term loan only 36 days per quarter. Only 36 days per quarter. So it says that state can take short-term loan for only 36 days per quarter, like your credit card limit. Okay. So what is the interest at which the loan can be taken? So same as the repo rate. It is fair for all state. Okay, it is same as the repo rate. You can see it is linked to the prevailing repo rate. The interest is linked to the prevailing repo rate, and it is same for all state. And if you have any surplus cash, suppose any surplus cash is there, what to do with surplus cash? You have to invest in 14-day intermediate treasury bill. Okay, you can invest in 40 days government bond, and they will earn interest like your FD. They will earn interest like your FD. So if you have any kind of surplus cash, you invest in 40 days government bond, they will earn interest like your FD. So that is ways and mean advance. Is it clear now? So we have talked about 36-day rule. Interest rate is fun fact is that RBI print 3,000 crore notes a year. You can see the volume, 3,000 crore notes a year. That is 40 note per person. What about the quality check? Yes. So quality check, you have to remove any kind of soil notes. Okay, like your soil notes, it very well. So basically this matter for business owner. So what we have just discussed about TLTRO, right? TLTRO meant company got loan to pay salary during lockdown. Then common citizen, for common citizen, if notes are clean, it means fewer fake currency risk. And for taxpayer, WMA rule prevent a state from overspending. So now let's summarize, recapitulate what we have covered in this particular slide. I'm just providing you a recap here. First of all, we talked about LTRO and TLTRO, right? What it is all about? So this is RBI 2020 loan festival to save business. Okay. And I told you some key point about LTRO. This is these are issued at the policy repo rate for 1 year to 3 year tenor, and they require bank to invest the proceed in corporate bond, commercial paper, and non-convertible debenture. That's why we call it 2020 loan festival by the bank. Then we talk about the wage and mean advance rule. I talk you about there is something called 36-day credit card. It can act like a 36-day credit card, right, with repo rate interest. Interest is repo rate. Okay. And now I told you about cash king. Who is the cash king? RBI act like a cash king. Okay. So this is India's only money printer. Now next point we discussed about the notes. I told you about RBI can issue notes up to 10,000. How much maximum? So question may be asked that the maximum loan that can be offered is 10,000 loan. Okay, maximum loan that can be offered is 10,000 rupees loan. Though highest now is actually 500 only, not 2,000. Now there is something called security war. What is this security war? Have a look. There is something called security war. So basically new notes have hidden future. If there is a new notes, it have hidden future. What are the hidden future? Like it might have hologram, right? It might have color shift link, like money's antivirus software. If we talk about the current currency lineup, so 5 rupees notes are rare, 10 rupees notes, 20 rupees notes, 50 rupees notes, 100 rupees notes, 200 rupees notes, 500 rupees notes. And if we talk about the coins, 50 paisa is now rare, 1 rupee paisa, 2 rupee paisa, 5 rupee paisa and 10 rupee coins. These are the coins. Now let's talk about the coin rule. You must know this is called legal tender limit, which means if there is a rupee 1 means 1 rupee plus coin. Okay, we can call it rupee 1 plus coins. Okay, shop must accept up to 1,000 rupees total, right? So that is what shop can do. They must accept up to 1,000 rupees total. Fine. For example, suppose you are paying rupees 500 bill with, you can pay 500 bill with 500 into 1 rupee coin. That is illegal, right? So suppose you have to pay 500 rupees bill and you have 1 rupee coin. So if you have such 500 1 rupee coin, you can make the payment. Then 50 paisa coin. Suppose you have 50 paisa coin with you. The shop must accept up to 10 rupees total. So suppose if you are trying paying 100 rupees bill with 200 into 50 paisa coin, the shopkeeper can refuse, right? And what about the beyond limit? Yes, beyond this limit I have told you, right? So beyond this limit, this is voluntarily acceptance, right? No jail for refusing. So petty shop once often reject 5 rupees, 10 rupees coin. They are not wrong legally. Okay, now if we talk about so what we just know, behind the scene, one more point you must know, that coin, they are minted by the government. Coins are minted by the government, and there is an act which we call Coinage Act. Coinage Act of 1861. Sorry, Coinage Act of 2011. Under the Coinage Act of 2011, these coins are minted by the government. And if we talk about the notes, so notes are printed by RBI. Notes are printed by RBI with Gandhiji face, right? So that is the point. Now let's recap. Let's recap what we have just discussed. I've just told you about that legal tender limit we have just talked about. I told you that 1 rupees coin, more than 1 rupees coin up to 1,000, and 50 paisa coin up to 10 rupees. So what you can refuse? So you can refuse coin payment beyond this limit. Coin payment beyond this limit can be refused. Soiled and mutilated currency can be refused. Now if we talk about the evolution of the currency notes in India, so let's talk about it, how currency notes got evolved in India. Did you know that 500 notes were banned twice in the history, right? The first one, private bank era. The first one is the private bank era. So what happened during that era? That pioneers were Bank of Bengal, Bank of Bombay, Bank of Madras, they printed notes. They were called pioneers. And the fun fact is that like today Paytm and PayPal, but with physical cash. The problem was that 100 rupees plus coin design, okay, it was easy to counterfeit, like fake college ID. Then British takeover. By the Act of 1861, the British takeover, government become the sole printer. The government monopoly comes into picture. For example, like RBI taking over from Paytm Payment Bank, right? So earlier private bank era, like Bank of Bengal, Bank of Madras, they printed notes. But later 1861, government took over the control. Then comes RBI era, that start from 1935 plus. So the first note was 5 rupees note in the January 1938, right? And rupees 10,000 notes same year. Soccer was that 10,000 rupees note in, you can think, right? That is 20 lakh today. This 10,000 note in 1938 is equivalent to 20 lakh today, right? Then comes demonetization roller coaster, right? The first demonetization happened in 1946. It banned 1,000 and 10,000 rupees note. Then comes in 1954, right? It's reintroduced them, right? Like bringing back 500 rupees note. and then 1978 it was again banned. Then 2016 by Modi ji, right? Notbandi. You lived this drama, right? I hope you. Then we have who print what. So remember, I told you na who print what. So RBI can print what? RBI print notes. How much up to? RBI can print notes up to 10,000 rupees denomination. And what government do? So government mint coin. Government mint coins, right? Even 1 rupees note till 1994. Fun fact is that rupees 1 note has financial secretary signature. Remember, this will be asked. In the rest, it is governor signature, but if it is rupees 1 note, it is financial secretary signature. Right? Who sign on the rupees 1 note? Financial secretary. Let's recapitulate what we have just covered now. So first of all, we talk about the page 1. In the page 1, I told you private bank printed money. Private bank printed money in the phase 1. Then we talk about the phase 2. Phase 2, what happened? That British government took control. British took control in the phase 2. Okay. Then we talk about the phase 3. What happened phase 3? That RBI become the money boss. When it happened? It happened in the year 1935. And the real drama was 500 rupees and 1000 rupees banned 3 times. It has been banned 3 times. Thrice it has been banned in the last 70 years. This is the real drama, right? Okay, friends. So, friends, let's end the part 1 lecture here, right? So, let's recapitulate what we have covered so far. This particular entire session we will cover in 3 parts. So, let's recapitulate where we started. So, first of all, I told you about there are 4 regulators. Who are the 4 regulators? RBI for bank, SEBI for stock, IRDA for insurance, PFRDA for pension, right? Trust, fairness, and these things are ensured. Then the next slide, what we talked about? We talked about RBI was established on 1st April 1935. Inspiration it got from Ambedkar book. Earlier it was the central bank of both India as well as Burma. Nationalization happened in 1949. And leadership, if we talk about the leadership, there is a governor, there is deputy governor, 4 deputy governor plus board is also there. Then in the next slide, what we talked about, RBI goal is to make the price stable, is to make the bank safe, and to make the payment smooth, right? So these are the 3 main goals. And for that there are some direct tool and indirect tool. We are just talking about in the next slide. Then we talk about the power of RBI. It control money, it save bank, it guard rupees, it backs government money. These are the points which I just talked now. Now in the next slide, what we talked about RBI Trinity. RBI Trinity means inflation control, growth increase, and save bank. These are the 3 roles, and these are some tools which RBI use to maintain it. CRR, SLR, repo rate. These are direct tool. And MPC, we talked about Monetary Policy Committee. There are 6-member committee, right? 3 members from government, 3 members from RBI. They meet bi-monthly, right? They meet bi-monthly. We have just talked about. Then in the next slide, we talked about LAF. LAF act like daily money valve. For example, repo and reverse repo. Then we talked about repo. Repo, these are master interest rate. OMO, in the case of OMO means open market operation. So basically, bond trading for liquidity is called OMO. So you are trading bond to maintain liquidity, that is called OMO. And MSF, SDF, they are like emergency cash button. Okay. In the next slide, what we talked about, MSF rate and SDF rate. You remember it? MSF and SDF rate. Okay. So then we talked about MSF are like emergency window, SDF are like cash vacuum. MSS market stabilization scheme are like bond powered money sponge. WMA, that is wage and minimum advance. These are state salary day loan. These are called wage WMA. Then we talked about LTRO and TLTRO, 2020 loan festival because of COVID. Then WMA, wage and minimum advance. This is a 36-day credit card, right? And cash king, RBI act like a cash king. So these are the points which I have just discussed now. Then we talked about the phase 1. In the printing of money, the phase 1, it was private bank control, private bank printed money. Then comes phase 2 from 1861 when RBI took control. I think yes, 1861. British government took control. Then phase 3 from 1935 when RBI took control. Right? You must remember that 500 rupees note and 1000 rupees note has been banned 3 times in the last 70 years. So these are the points which I have just discussed now. In the next slide, in the next video, we will